Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, November 1st, 5:38 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a longer-term correction, currently in a bear market rally or short-term uptrend, as we had a big shakeout about a week and a half ago on some bad economic news that got rid of all of the sellers at that point in time, washed them out. The rubber band just got stretched too far to the downside, and we had a move to the upside, and we've been continuing that, consolidating over the last couple of days, waiting for the Fed rate hike announcement and guidance going forward. Very big meeting tomorrow. Seems like all these meetings are big. All these jobs reports, all these inflation reports are very closely watched now and have normal then oversized impacts on the markets. Let's check over here on the trend gauge. You can see still up, uptrend slash bullish on market leadership. We have some good, some bad, and some ugly in our portfolio today. We'll go over that when we talk about what we're holding and what we were watching today. Short term, we're still on uptrend slash bullish, but the red arrow indicates a close back below the 21-day exponential moving average on the NASDAQ 100. Again, this could look completely different tomorrow depending on what happens with the Fed, or very possible that we get a reaction in one direction in the afternoon and completely opposite on Thursday. We've seen that several times this year. Medium term, downtrend slash bearish on the relative to the 50-day moving average across the indexes, but probably relative to where we are looking better. The NASDAQ 100 continues to be the laggard there, and the Dow the leader. Long term, also downtrend bearish. The green arrow indicating the Dow Jones Industrial Average, which has passed the 200-day moving average, several closes above it now. So that is the leading index. So what happened today? Big gap up at the open, but all it was a failed breakout. Opened right into some key resistance areas, made the high within the first 5 minutes. Harsh reversal down, but it was impacted again in lockstep with what's going on with interest rates and the dollar. We started off with the dollar down and rates down, and we ended up with rates trickling higher throughout the day and the dollar just closing barely down but showing strength throughout the day. And the inverse correlation certainly stood in place today. FOMC tomorrow, again, the key thing that we'll be watching for tomorrow. So a lot of the analysis today can be completely undone at 2 p.m. Eastern time tomorrow, and then the press conference at 2:30. But on the day, G6 positive of 0.36%, S&P down 0.4%, NASDAQ lagged again down 1%, Dow down 0.25%, mid caps up 0.4%, Russell 2000 small caps up 0.25%, global diversified 60/40 stock and bond positive 0.16%, in-house we're down 0.6%, this is actually 0.69%. Give or take, and when we'll talk about what hit the portfolio today and what was benefiting the portfolio today when we break into the chart. So we'll get into the tail of the tape and then some key charts to look at. But first, let's give a primer on what we do here at Revere. We take a look at the state of the market and how the major indices are trending relative to their short-term 21-day moving average, that's the green line, the medium-term 50-day moving average, that's the red line, and the black line is the long-term 200-day moving average. When we're trending above all three of these and they're configured short-term, above medium-term, above long-term, we are basically the equivalent of putting all your chips in the middle. If you want a poker analogy, we are invested as heavily as we can comfortably be in leading stocks in the leading sectors and in the indexes. If the market starts to fade, our stops will take us out of the market, not our opinion. What's actually going on is what takes us out and keeps us in. And if we really start to roll over, the slopes of these lines will start to roll down, and that's a big indicator that the correction may be more than just a little consolidation. And then if we break the black line, the 200-day moving average, this is when We completely change gears and get very defensive, and the reason for that is this chart right here. The last 13 bear markets, these all occur beneath that black line, the 200-day moving average. On average, you from the high to a break of the 200-day is approximately 12%. You can get out at 12%. Congratulations to you. You saved yourself all of this carnage. Now, breaking doesn't automatically mean you're going to go into a bear market. You can battle back and forth for days or weeks, but definitely be on guard when we're below the 200-day moving average. That's what we do. That's how we protect our clients' capital. Risk management is number one here at Revere. We hear it all the time. People tell us, I talked to multiple advisors. You guys are the only ones that talked about protecting the downside. And we especially cater to people approaching retirement because you can't see, you just do not want to see your nest egg decimated by a severe bear market. And if you're interested in this approach, give us a shout. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner, Dan Stewart, dan@revereasset.com. Weren't we clever coming up with that naming convention? And Dan's a CFA, Mr. A to Z, and all things financial. He'll answer any questions you have and point you in the right direction. So getting out is one thing, getting back in is something else. We've got plans for that too. We use several technical signals, such as a false breakdown, which happened here in May, which happened here in July, and most recently what happened here on October 13th. And you can participate in bear market rallies there. You never know how far they'll go. It's like catching a wave. You don't know if it's going to be a great wave or a shallow wave or a weak wave. But we ride the wave, and when the wave ends, we get back off. Sometimes it's minor gains, sometimes it's excellent gains, but we'll let the market decide that. But again, under the 200-day moving average is when it's time for protection. But look, exit up here, 421 was the key date. That's when we rolled over. We've gone from 4,500 down to 4,100. Almost 10% lower is where we'll be getting back in from where the index rolled over relative to the slope of the line trending lower. You can see we failed once here in mid-August. That started the next leg down. This rally's intact. We'll see what the Fed has to say about that tomorrow. If you look at a 60-minute chart, very key area, you can see this breakout above 3,800. First of all, we broke down below 3,800 here back on September 21st. Tried to get back above it at the beginning of October, and we could not. Had the next leg down. Several rallies, finally did get back above it here on October 25th, but then 3,900, which is where we broke down here yesterday. This is how support and resistance works. 3,900 support here, support, we couldn't break through it. We finally broke through it. Okay, now we're trying to get back above it. The floor has switched to the ceiling. We can't get back above it. We fail here, and then we go to a lower point. That's what's been happening here too. Rally into 3,900, fails, pull back, but now we're above 3,800, and where it was resistance here, it's turned back into support. Now let's see if we can get back above 3,900. We failed here on 10/28, and we failed again today with the gap up. But again, all we're doing is failing into resistance. It's very normal to fail at resistance. You look to the left side of the chart, you can see where it was broken and unable to be reclaimed, going all the way back to when it was broken here on September 15th. And it's very clear so really what we're looking at is two key levels here, 3,900 on the upside, 3,800 on the downside. We break back below 3,800 with the Fed. We'll pretty much get near flat, depending on how our positions are acting. Oils are holding up very well, and we've got some gains now in those, but we've got our stops in place. And if the Fed is a positive reaction, a bust above this 3,900 area that stands, sometimes you break above and you fail immediately, and it's a failed breakout, just like we saw this morning. Failed breakout could be a failed breakdown, could get both of them in the same day. That's about a 2.5% spread here between that low and the high. We'll see how things play out tomorrow with the reaction of the Fed, but right now 3,900 to the upside, 3,800 to the downside, very key areas, and they show up very well on this 60-minute chart of the S&P 500. Let's go to the NASDAQ 100, the weakest of the indexes. It was weak again today. One close above the 21, back below it, declining 50-day moving average, hasn't quite tested it yet. Again, we'll see what the reaction is, but look at the relative weakness, which started here on August 4th, just trending lower. Terrible reaction to earnings for 4 of the big 6, actually 5 of the 7 big components of the NASDAQ 100. In fact, Pepsi has now passed Meta in market cap. Last time I checked, let's double check that. We used to refer to them as the top 7, the big 7. Here's Pepsi with a $249 billion market cap. Here's Meta, still at a $256 billion market cap, so holding on by a thread as it bounced 2% today. I think they swapped places yesterday, but certainly not a good look for Meta there. Where were we? Let's go to the Dow Jones Industrial Average next. This is the leading index. Undercut but closed right back above the 200-day moving average today. So let's call it a goal line stand with the 200-day today, but again, could be completely changed tomorrow. Today's highs, both on the upside and the downside, because it was a negative reversal, are going to be key across all of the indexes. But there's the Dow holding on to the 200-day moving average. It is 4.6% above its 21. Really fantastic October for the Dow. But as I talked yesterday, this can be manipulated by heavy money flowing into just the top 7 or 8 components of the Dow, because it is a price-weighted index. Let's go to mid-caps. Mid-caps approaching the 200-day moving average, but multiple closes, 5 closes now above the 50-day moving average, and continuing relative strength over the last week and a half. Looking good there on mid-caps. Let's go to IWM. Small caps, also close to the 200-day moving average, 5, 6, 7, 8 straight up days for the small cap index. Coming into the 200-day, 5 closes above the 50-day, really flattening out on the slope of the 50-day also, and the 21 green line getting ready to come back up through it. Again, the key is going to be the reaction tomorrow. We are in overbought territory on the indexes, most of them, but you can see you can stay overbought for weeks at a time here, or you can roll over and come right back down. We respect price and we don't predict either way. Let's go to UUP here so we can show how this impacted on an intraday chart what was going on. You can see the dollar gap down, put in the lows of the day immediately and started trending higher. Compare that to what was going on with the S&P 500, gapped up, immediately started trending lower. Major inverse relationship between the dollar and the indexes, and you can see here really just consolidating for most of the afternoon was the dollar and also the indexes. Now let's compare that to the yield on the 10-year, the TNX. You can see the yield started much lower, which was good for stocks, but as soon as it started going higher in line with the dollar, the market started going lower. So major impact on bonds and the dollar on stocks. We're at the mercy of them, and until that changes or that we get a trend one way or the other on them, it's the inverse relationship stands, and it is what it is. Holding the 21 is the TNX for right now. The UUP closed right on the 21, bounced off the 50-day moving average today. Let's look at the VIX, which had another close below the 200-day moving average. VIX down today, along with the market being down. You don't normally see that, but 3 tight closes here. That just means that along with the VIX and the indexes are just coiling for a move in one direction or another. We'll see which way that resolves. Good day today for gold and silver stocks. Closed on the ADMA. We've been failing for the last 4 weeks trying to get above the 21. Let me click my alert back in there so that I'll know if we get back above. And let's take a look at Bitcoin ETF futures on a 60-minute chart, as we've been battling between that 13 and 12.5 level, and you can see that looks like a bear flag, or it could be a bottoming pattern. But for now, holding 12.5 below 13, consolidating this move up. You could argue that this is just a bear flag by itself, or you can argue that it's a flag if you go longer, this being the flagpole, this being the flag. So it'll break out one way or another. The market always is ultimately the final arbiter on what goes on. So let's bring up the tail of the tape, and then we'll look at some individual charts. Not much change from the technical picture. Still have the macro headwinds. Put call 0.95. VIX, as I said, was down slightly today. Fear and greed at a 58, operating under the bull case on a short-term basis since that follow-through day on 10/21. We had strong jobs data came out at 10 o'clock. The Fed does not want to see strong jobs data. You can see on a 5-minute chart here. This is the 10 o'clock bar. Actually, it's 1-minute chart won't show up here completely, but on a 1-minute chart right at 10 o'clock, you can see a move down, a breakdown. As soon as that data come out, the algos read it as quick as they can, and it goes to the futures, and then it goes in microseconds through to the indexes. So day count up one day with a consolidation, now to a down day with the failed breakout and outside negative reversal. Fed again tomorrow at 2 o'clock came in with a positive expectation. The gap up reinforced that. The reversal broke it. Failed breakout. FOM will be neutral tomorrow depending on what the reaction to FOMC is. Breakout failed here today, closed at support and resistance on the S&P, closed in right at the low end of the range on this support level on the NASDAQ 100. 4-hour base close on the indexes today, just really waiting, biding time for what's going on tomorrow. You can see what sectors were strong. The dollar started out weak, ended up still negative, but basically flat. Nat gas, what it gained yesterday, it gave up most of it today, down 7.6%. Tech sectors were weak. Software was weak. We'll take a look at the charts that we were focused on. Dow held the 200-day moving average. That's another focus. What do we do in-house? Let's look at these first, but first let's do the bottom line. We gapped up, we reversed, again driven by the dollar and bonds, FOMC in the morning. When you see two closes between a support level and a resistance level, you know we're coiling for a move one way or the other. The market can only ever do one of three things: trend higher, trend lower, or consolidate. Right now we're consolidating, waiting on the Fed. So let's take a look at the individual charts of what we were focused on, and we'll talk about why we were focused on them. First of all, so Wing continues to act well after its gap up, consolidating the gains on lower below average volume. This looks pretty good. It was a breakout, not quite to all-time highs if you look at the weekly chart, but you can see the resistance over here from going back to 2021. But chicken wing deflation, you don't cut your prices once you raised them, and that's one of the reasons why Wingstop had a good reaction to earnings. First Solar follow through to the upside today. This was really tough to read. Day one, you shook out after earnings, high, low of the range. Early, I regret not buying this. Early strength was evident in First Solar, and you had a day two higher volume. This is really rare. Couldn't tell till the end of the day when the volume's finalized, but that's a good sign for this. And then a third day higher now. First Solar has taken the reins from Enphase. We own Enphase. We're basically flat on it. Negative reversal today, very similar to what's going on with the markets. But it is still just consolidating its move higher on earnings. MedP, a new name. We're always looking for new names, and from earnings, if you're focused too much on the old names, the older names seldom lead the next up leg, and we're seeing a plethora of new names now. That's why we're paying special attention to them. MedP continues to consolidate its earnings gap up. Caterpillar, another good day here. holding its gap. 220 area is resistance here, still inside its base. Relative strength at a new high. Caterpillar looks really good. Then some things that got on the focus list this morning because of earnings, and we're going to have several of them tomorrow because of their earnings after hours today, which we'll talk about also. But Uber, gap up. And the volume's big, 246%, up 12%, still in a base, but gapped all above the moving averages. So what do we do with the gap up? We add it to our list. We set alerts above the low and the high of the day to see how it plays out. So that's why Uber got on the list. HLIT, something that we owned, have been having nice gains in it. Only a 2% position because of how thin it is. Beat earnings. From what I read, it was actually upgraded twice today during the day, but that didn't matter. There were sellers today, 266% above average volume. Our double-digit gains for this now down to basically flat. A break of today's lows will be a sell. We've got the one close below the 21. The fact that we had nice gains is why we can still hold on to it, and maybe it'll act like Shockwave, which was just an absolutely violent stock with these two big up days, one big down day, and then slowly reclaiming the moving averages. There's no way with a big position that you can sit through this. That's why we're taking smaller positions as this fledgling rally continues to play out. But HLIT, so we're still in that. That was the ugly for the portfolio today. The bad for the portfolio was AEHR as Wolf. The silicon carbide, two of the big stocks got hit. Wolf got hit, and ON, which reported earnings yesterday. We wanted to see how it would follow up today. Volume lower, didn't break the low. You can see we've got an alert here at the low of the day. Very often in a leading industry group with a leading stock, you'll get one shake and it'll continue higher. Well, it closed at the low of the range today, couldn't get back above the 21. So we'll give today about a C on this. The only good thing is it didn't break the 21. A second good thing is that it's right at the 200-day moving average. We're not involved in either of these, but AEHR is a tangent play on those as they create the test systems used by those two stocks. And AEHR seems to have topped yesterday, still holding on to the 21-day moving average, back to the pivot. That happens frequently. You don't like to see, again, double-digit gains reverse, but these are volatile stocks. We're still holding on to this with basically we're flat on it now with the 3% position. So that was the ugly and the bad. Let's take a look at the good, and that was STNG. Oil and gas transport, Scorpio tankers, up on good volume, closed near the high of the day, only 70% above average volume, but it was being accumulated all day. If you look at the intraday chart, little shake here, and then just trended higher, a little bit of a pullback, trended higher into the close, little give back into the close, but all in all, I'll give this an A on the day for it's an earnings reaction, so it goes to it goes on the appropriate lists for tracking going together, and this was the good one in the portfolio today. Another one that we were tracking based on pre-market was a former leader, Arista Networks. This started out down on the day. Big positive reversal, as you can see here, opened down, immediately bought up, flagged, and then took off to the upside. This is accumulation on ANET. Anybody that wanted to sell sold it here. So we put that very closely on our watch list now to see how it plays out going forward. Let me create my alert while I'm thinking about it. We're going to go with 128.50, just 50 cents above today's high. But you can see a big shake on this within a big flat base. The numbers pretty good, 69% earnings growth, 57% sales growth. Those are CanSlim numbers that you're looking for. A 41% earnings increase this year with a 30 PE, dropping to 14% next year. But note the green arrows, meaning they were recently raised. That's a good sign. So we'll see what Arista Networks does going forward. And that's the end of the stocks that we were focused on, and also the end of today's report. So as always, love to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH, 855-732-5932. Remember, it's not how much you make in the market, it's how much you can keep. Expect a Significant reaction one way or the other with the FOMC decision tomorrow. A lot of variables in this one. Sounded like Biden let the cat out of the bag early when he said he agrees with the Fed's softening position. Well, the Fed technically didn't say they had a softening position, although it was a little bit leaked by the Wall Street Journal a couple Fridays ago that kicked off that rally. So we'll see how that comes out. But honestly, that is what the market is expecting, is for him to be dovish. And if he's not, there could be some fireworks to the downside. We've got our stops in place. We've also got our buy list ready either way. So wrapping up Tuesday, November 1st, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.